Hi guys, my name is Ryan, the Frugal Analyst, and recently I've been putting money into this platform called Cadence, and they're giving out 10 to 15% APY on short-term asset-backed securities with a duration as short as 1 month to 1 year. And historically, there's only been 2 defaults out of over 100 deals. So initially, when I heard about this platform, I thought it was too good to be true. And I'll try to explain the platform and my experience in this video. And so far, I had 5 months of experience in the platform, and I basically nibbled a few $1,000s to try it out. And recently, I've been wanting to put more and more money into the platform due to the high fixed interest rates. So overall, I'm not an expert, but I do have some skin in the game to share my experience with you guys. As always, I'll have a table of contents in the description of this video so you can skip around if you want to. Now let's start with investment background. What is Cadence investing in? Well, that answer is a little bit complicated. Cadence is an investment platform where investors invest in asset-backed securities. And let me share some detail, and feel free to skip this section if you are already familiar with the finance term. The finance folks calls it asset-backed securities, or ABS. And basically, these are loans backed by some form of assets and their cash flow. For example, one of the biggest in the world is mortgage-backed securities, and these are loans backed by mortgages. And banks would issue these mortgage-backed securities so that they could liquidate a good majority of their position and put that money into higher earning assets. So graphically, for mortgage-backed securities, basically a pool of mortgages have some kind of value. Let's call it $1 billion of real estate plus the interest. Now, if the mortgage owner does not pay, the bank can take away the house and sell it. So the mortgage has some real underlying value. Now, to get money at a cheap rate, the bank basically securitizes these assets and basically setting up a loan guaranteed by the mortgages. Only a portion of the total portfolio can be loaned out, leaving some form of buffer at the end just in case if the pool doesn't perform as expected. Now, it is the same concept with Cadence, but they're not mortgages. Each deal is secured by a different type of assets, and they have roughly 12 different types or 12 different originators giving loans backed by the cash flow or the assets underneath the deal. Now let's go through a deal sample in Cadence. So one of their originator is called Thunder Road Financial, and they basically provide financing service for motorcycle dealerships. So Thunder Road as a financing company needs money, and they do have a company that will purchase the loans. But there is a timing issue. Usually investors want to have actual tangible cash flow before purchasing the loan to reduce the risk of defaults. So after the motorcycle has been purchased and financed, the originator have to hold on to the assets for a fixed period of time. Now this is where with Cadence structured a deal where investors can purchase loans backed by the assets itself. Now the platform tries to share as much details as they can. So for Thunder Road, for example, they have a loss cushion of roughly 10% with historical annual defaults around 2.1%. So the total first loss coverage is roughly 19 times more than the historical defaults because the loan is only 3 months. So the asset have to default 19 times faster than historical average for the loan to lose money. So that's a pretty good safety net in case things get sour. Now if the borrower stops making payments, the loan holder can repossess the motorcycle, so there is some value to be claimed if something goes wrong. But in reality, it is more of a strong incentive for the originator to pay back the loans. Another example is salt lending, where the loan is backed by cryptocurrency. Now, prices of crypto is volatile, so usually the loan has a large buffer based on the underlying asset. This deal, for example, has 50% loan to value. So for a $100,000 loan backed by cryptocurrency, there would be roughly $200,000 worth of cryptocurrency, and those prices are gauged in the open marketplace. Now, if the price of crypto falls, Cadence will have the right to liquidate the cryptocurrency and turn it into cash. And to add more transparency, for this specific deal, for example, daily reports of loan to value is published every day for the investor to understand how much risk is in the deals. Now, each deal in the Cadence platform is very different, so investors should read the document on how each deal is structured and their risk. Now, looking at deals on the platform, interest rate currently range from 9 to 15% APY, with term ranging from 1 month to 9 months. So it is fairly short term. And looking at the platform, I usually see roughly between 0 to 2 deals available to invest at one time. So it is limited, and it's a first come first served basis until it is fully funded. The minimum amount to invest in the platform is $500, and historically there's only been 2 deals that defaulted, which is listed in their website out of roughly 100 plus deals. So not bad, and it did occur after COVID. So I'd be very curious on the outcome of those 2 defaulted deals and what the platform can recover. From my perspective, the main thing about investing in Cadence is that I'm trusting the underwriting quality of the platform. Unlike ABS deals with mortgages or other large securitization, Cadence deals are not rated, meaning there is no third party auditing their underwriting like the typical asset-backed securities where a company like Standard & Poor's, Moody's, DBRS would rate the deal to their appropriate risk levels. And the benefit is, of course, the high fixed rate. Now, a slight conflict of interest is that the platform makes money from origination fees. So maybe they are incentivized to originate more volume to make more money and can possibly reduce the quality of the underwriting. But given such a complicated investing platform, a lot of the money comes from large accounts. When I tracked down the transaction of a few different deals, over half of the deal dollars is funded with accounts contributing more than $100,000 per deal. So what that means is that Cadence is dependent on these large accounts to fund the deals, and smart money can leave very quickly if the deals are not good. Now, let me explain my personal experience. So far, I've invested in around 8 deals, putting roughly $4,000 into the platform. Now, none of my deals have defaulted, and again, the only platform defaults, it's the 2 loans coming from Solar for America, and they actually filed bankruptcy after COVID. So hopefully the platform can prop up their underwriting post-COVID environment. Now, my current plan is to add more funds to diversify and basically invest in every deal that comes available. Right now, I'm at around $500 per deal. I'm going to move that up to around $1,000 per deal. I think right now the platform is giving a much better return than putting money in other fixed income securities. And the diversification in multiple deals hopefully allow me to make a good risk-adjusted returns. Again, the biggest dependencies investing in the platform is the Cadence underwriting. It is nice that the platform is trying to be as transparent as possible, but in reality, with the data provided, I don't think I could really calculate the risk-adjusted return, as all of these deals is very unique in their own way. So betting in the whole platform is probably better than picking individual deals. Now, let's talk about due diligence. Cadence is a startup, and recently they raised $6 million after COVID started, so that's pretty impressive. I looked at the profiles of the team, and a lot of them have experience working in banking, so that's a pretty good sign. I also listened to their investor presentations, and they are pretty solid. At a high level, things seems to check out with the platform's sustainability and efficacy in originating loans. So in summary, the Cadence platform is giving out 10 plus % APY on short-term investment deals with only 2 defaults in the past with over 100 plus deals. I made money in 6 deals and looking forward to add more money to diversify and basically bet on the success of the platform. I think the platform is incentivized correctly and they need to have quality deals for investors to come back. So that's it for my With Cadence review. Let me know what you guys think in the comment, and I'll see you in the next Frugal videos. Thanks for watching.